Hello and welcome to today's presentation on Savannah Energy PLC. My name is Andrew Knott and I'm the Chief Executive. Okay, so first, the first slide really covers what Savannah is, the essence of us. We're a leading African-focused British independent energy company. We have a future contracted revenue stream which is derived from fixed-price long-term gas sales agreements that have a weighted average remaining life of 17 years and over $4.3 billion of remaining life of contract revenues. We've got strong near-term growth expected from additional gas sales agreements in our operations in Nigeria and from potential delivery of first production from the R3 East project in Niger. In our existing business, our growth ambitions overall are underpinned by a 31.4-year reserve and resource life. What I would also say is we've announced that we're in the process of acquiring the assets of ExxonMobil in Chad and Cameroon. For regulatory reasons, I can't discuss this in today's presentation, but that is also another potentially exciting source of future growth for our business. We have a well-established track record of delivering capital projects on time and budget, which I believe is unique in our sector, and a proven track record of geotechnical excellence with 5 exploration discoveries from 5 wells drilled to date since the company was founded. Our ticker is SAVE, S-A-V-E. Our ownership structure is very much insiders and institutions who in aggregate own over 80% of the business. On the bottom right-hand side of this slide, you can see some of the major investor groups that we have, and you can see it comes from some of the largest and most prestigious investment firms in the world. Last year, we did 19,500 barrels of oil equivalent per day of production, and we ended last year with 2P and 2C reserves and resources of 157 million barrels of oil equivalent. In terms of the financial performance that we delivered last year, our total revenues are $236 million. That's up 23% versus the full year 2019 pro forma. Adjusted EBITDA was $184 million. That's up 19%. And our adjusted EBITDA margin was 78%. Group cash balance was $106 million. Net debt was $409 million. From an ESG perspective, I'm pleased to report that we have industry-leading carbon intensity, diversity, local content, and HSE performance last year, which I'll go on to discuss later in this presentation. For this year, 2021, the guidance that we issued at the beginning of the year, total revenues should be greater than $205 million. Group operating expenses plus admin expenses should be between 55 and 65. Our DD&A is $19 million fixed plus $2.6 per BOE produced. And then our group capex is $65 million. So more about what happened to us in 2020, which really differentiated our business. We grew our revenues in 2020 by 23% in an environment where the world GDP fell by 4%. We grew our cash collections by 11% in an environment when the super majors reported net record losses of $89 billion. We grew our production by 14% in an environment when the industry cut production by 5%. And we increased our headcount by 25% in an environment when the industry reduced its headcount by 10%. And I think that last point is really important. We're a company which is growing strongly. We're investing counter-cyclically, and we expect to benefit from the key industry trends associated with the divestment programs of the super majors. We're very strongly positioned for growth and are recruiting aggressively on that basis. Our cash balance was up to $106 million. Our net debt was down to $408. We had a broadly stable EBITDA margin of 78%. Similarly, you can see our interest coverage and leverage improved. And the environment between where our EBITDA margin sits and the super majors or the wider industry's EBITDA margin, you can see we're a materially more profitable business than the industrial average. From an ESG perspective, there's several key points that we would make. Firstly, our carbon intensity is lower than the industry average. It's about half. And it's being reduced faster than the industry is reducing its carbon emissions. So we reduced our carbon emissions by 24% last year. Industry reduced by 12%. We sit at 12.8 kilograms of CO2 per BOE produced. The industry is sitting at 24.1. From a diversity perspective, 35% of our managers are female, which is in stark contrast to the super major average diversity, as you can see. And then from an HSE perspective, very, very strong HSE performance, as you can see from the right-hand column of slide 6. Similarly, we make a significant contribution to the communities in which we operate. Nearly $50 million in full year 2020. The next set of slides really talk about our strategy. There's really 5 prongs to that. The first is we're seeking to deliver value safely and sustainably. The second is we're looking to optimize our existing portfolio performance. So to get the best out of the assets that we have. To deliver organic growth, that's primarily through additional gas sales contracts in Nigeria. That's through delivering the development from the exploration discoveries we made in Niger. To deliver value accretive inorganic growth, that's M&A activity, which we think we're very strongly positioned for, given our access to capital, industrial contact network, and strong and proven ability to operate within our African focus area. And then ultimately to provide cash returns to shareholders. From a sustainability perspective, we've now aligned our sustainability strategy with 14 of the UN SDGs, split into 4 pillars. The first is to promote socioeconomic prosperity. We strongly believe that our industry promotes socioeconomic prosperity, both directly and indirectly, through use of our hydrocarbon products and in the fiscal contributions that we generate. Secondly, to ensure safe and secure operations. Thirdly, to support and develop our people, which is a real core differentiator in Savannah. The investment we make in L&D programs is really differential compared to our peers. And 4, respecting the environment by producing our hydrocarbons in the most effective way possible. Whilst we have aligned our strategy to the most relevant UN SDGs, we also have integrated our reporting framework alongside 6 additional sustainability reporting standards, which are outlined on slide 10. There's a lot more information available in our annual report or through a discussion with our investor relations team around how we think about sustainability. That said, we spend a lot of time in our annual report, which I would encourage any investor who's consider making an investment in our company in the shareholder section, the market context section, the sustainability section, around why what we do is so important. And whilst we don't have time today to go through all the aspects of what we view as important from a sustainability perspective vis-a-vis our business, there are certain key points which I think are important. The first is enunciated in the table on the top left. Energy is fundamental to economic development. There's a very high correlation between income per person and energy usage per person. And as you can see in our countries of operations, and this is a logarithmic scale, you can see that the more income you have, the higher energy use you need. Further, there's also a very high correlation between life expectancy, between broader health outcomes, etc., etc., etc. So without energy, you cannot live the quality of life which people have grown used to today. And most importantly, you can't lift the emerging world out of poverty. And the fundamental situation is that today, over 82% of energy which is provided comes from hydrocarbons. Therefore, from a global perspective, to maintain our quality of life, what we do today is very important as we work towards a transition scenario. Even in any realistic view of how an energy transition will work, 50% of all the oil produced in history needs to be produced again in the period between now and net zero 2050. So hydrocarbons are a very, very important part of the energy mix going forward, in our view, and it is essential to helping the developing world develop. There's a whole lot more information around the relative contribution to the emissions issues, who benefits most, etc., in the publications that I mentioned in our annual report. And again, there's a lot more available from investor relations. But as a company which is focused very much on some of the poorest countries in the world and assisting them with their fiscal balances, with their developmental needs, I think that our company has a very, very strong social purpose. I would also highlight certain comments in relation to what I've just said, which I think are quite poignant. One from Elon Musk: if there's a button I could press to stop all hydrocarbon usage today, I would not press it. One from John Kerry, who's the US Special Presidential Envoy for Climate: you don't have to give up a quality of life to achieve some of the things that we know we have to achieve. I'm told by scientists that 50% of the reductions we have to make by 2050 or 2045 are going to come from technology we don't have yet. That's just a reality. I think the more important thing is that he's saying that Americans are not prepared to sacrifice quality of life in a climate change scenario. And I would argue that, quite frankly, that's simply not possible. There has to be a realistic discussion around the trade-offs and the importance of hydrocarbons in the current mix, which he's implicitly recognizing in our statement, which is essentially contradictory. And then from our own VP of West Africa, it's not negotiable that Africa is allowed to industrialize to lift our people out of poverty. The provision of energy is the only way to do this, and scientifically this requires hydrocarbon production. It's critical that we achieve net zero 2050 in a way that does not exacerbate global income differentials further, and that climate change strategists, who nearly all appear to be based in developed markets, recognise this reality. So again, we're very, very comfortable and confident in what we do as a business and the social importance of what we do. Moving on in terms of how we deliver the growth I'm talking about, I think our acquisition in Nigeria, whereby we bought the producing asset business 2 years ago, and the progress that we've delivered since that acquisition is very clear in terms of the value that can be created. Since we did that acquisition, total revenues have increased by 58%, cash collections by 46%, the proportion of sales to investment grade customers by 180%, and our production has increased by 50% on the assets that we acquired. So you can see that we have a team of people that are very competent, very capable of delivering and transforming on inorganic asset acquisitions. A little bit on the specific business units. This presentation was really designed for multiple audiences. So in terms of today, as I said before, the business has two separate business units, one in Nigeria, one in Niger. In Nigeria, we have two producing oil and gas fields, the Ukwo field and the Stub Creek field, gross about 1 trillion cubic feet of gas reserves and about 10% associated liquids on those fields. We currently supply gas to 3 customers: the Calabar Power Station, the Lafarge Cement Factory, and the Ebom Power Station. We've announced that we intend to start selling gas to additional customers. Our operational leverage to those additional sales is very high because there's very little marginal spend that's required to link those additional customers up. And I think you can expect news throughout the year and over the course of the next 12 months on how we're doing linking up these additional customers. But essentially, a big chunk of the additional revenues is expected to drop straight through to the bottom line. As I said before, the big benefits of this is that we're selling under long-term fixed price contracts, and our total contracted revenue stream is $4.3 billion. 17-year weighted average contract life. 99% of those sales are against investment grade credit guarantees. And I would also note that this excludes our liquids. So this is just for our gas sales, and then we have liquid production on top. Nigeria gas to power, big secular growth opportunity. You can see on the right-hand side that versus other continental champions, Nigeria is the largest economy in Africa. Power capacity versus population, power consumption versus population versus the other continental champions is incomparable. Very, very strong economic growth forecast. That will need even more power. That will need even more power. Gas is clearly the most realistic and sensible source for that power, both on a cost and carbon intensity perspective. So versus diesel, which is typically what our power is displacing, the price is significantly cheaper, about 72%, and the carbon intensity is about a third lower. In Niger, we have a very big asset. We have 50% of the main petroleum basin under license. That basin, we have a very significant bank of exploration prospects, and targets, which are the blue on the graph that you can see. We've drilled 5 exploration wells to date. We made 5 discoveries. We have plans to start delivering first oil from those discoveries through sales to a local refinery. We also expect and hope to recommence exploration activity, where we expect to generate similar success rates to that which has been seen in the basin to date, which is 80%. There's more information on this slide around the early production system we intend to put in place. Very simple technology, going into existing infrastructure, an existing large pipeline and an existing refinery, and attractive economics in the current environment. So unfortunately today, obviously we're presenting on a compressed timeline. Anybody who wants more information, I would encourage you to contact our investor relations team to arrange a meeting or to speak with your contact at Pareto. But really, to summarize, $4.3 billion contracted revenue stream, 17 years weighted average remaining gas contract life, 31 years 2P, 2C reserve resource life index, very strong profitability, 78% adjusted EBITDA margin, 2.2 times consolidated group leverage, strong anticipate organic growth from new gas sales agreements, plus the development of our existing discoveries in Niger, and then industry-leading key sustainability metrics. And this is before we talk about our planned and announced acquisition of ExxonMobil's interest in Chad and Cameroon, for example, and various other opportunities we expect to come our way over the course of the next 12 months. So I'd like to thank you for your time. And again, anybody who wants more information on any of the subjects that we've taught, please to contact our investor relations team. Thank you so much.